Today, crisis? What crisis? The latest on home prices. Hello again, I'm Martin North, the Principal Analyst at Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Lindsay David of LF Economics released a report, Let the Bloodbath Begin. He is the latest to point to significant falls in home prices ahead, suggesting that a peak-to-trough fall of 50% is conceivable in Sydney and Melbourne. That puts my 40% call, worst case from last August, into a whole new ballgame. So today we look at the points he makes, and we also review a segment I did on 7 Sunrise this morning. And by the way, if you value the content we produce, please do consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or consider joining our Patreon program, again, here is the link. We really appreciate your support to help us continue to make great content. The links are also in the comments below. So let's start with what we know. As investors are fleeing Australia's housing bust, sales of new houses have plunged to record lows, and home prices in Sydney and Melbourne metros have dropped 12% and 9% from their respective peaks in mid and late 2017. Combined, the two metros account for about 2/3 of residential property value in Australia. A 2-decade-long housing boom, interrupted only by a few minor dips, led to the development of two of the most magnificent housing bubbles in the world. The overripe bubble was pricked not by rising interest rates, the Reserve Bank of Australia's policy remains at record lows, but when bank regulators finally started to crack down on some of the bank lending shenanigans which had been required to inflate that kind of bubble, and when the Royal Commission into Misconduct in Banking, Superannuation and Financial Services was established in December 2017 to investigate these shenanigans, and then started revealing an epidemic of crime. The financial regulators, APRA and ASIC, have been sufficiently embarrassed by the findings of the Royal Commission to force banks to adhere to responsible lending obligations, writes Lindsay David. The regulatory crackdown restricts lenders' ability to conduct business as usual, he says, and this has resulted in a credit squeeze. Speculative investors who purchased more recently have been impacted the most, and some of them may try to sell either because they fear further price drops or because they have been caught out by the tsunami of interest-only loan resets. But selling at survivable prices will be tough, as buyers at these prices have evaporated, primarily due to stricter loan serviceability requirements as a result of the regulator crackdown. He says these developments risk turning the current minor credit squeeze into a looming credit crunch. And he sets out 5 stages in this potential bloodbath. Stage 1, beginning of the end, after sharp rises in property prices and mortgage debt levels, prices start to fall, and there is little to no impact on construction. The mindset, he said at this stage, is just a small pullback as part of the real estate cycle. Prices almost always rise in the long term. But stage 2 is as the bubble is pricked. As prices continue to fall further, a small number of property developers become insolvent or cancel future projects. Bank profitability begins to stall, with little leeway to grow their mortgage books. And the mindset here, he says, is that the property market declines were more than expected, but is argued to be orderly considering the large run-up in prices in the years prior to the peak. Stage 3 is rapid deflation. Here, property prices will fall well past thresholds that owners are comfortable with. Bank profitability stalls, and an escalating number of property developers default and or cancel future projects, resulting in rising construction job losses, and panic slowly starts to set in, especially among those with high loan-to-value ratios, loan-to-income ratios, and debt servicing ratios. The mindset here eventually shifts from denial to questioning how this can possibly be happening. Nobody could ever believe that prices could fall by this much. Stage 4, he says, is pain and reality. Recession starts and panic has set in. Lenders experience a net profit after tax wipeout, with losses starting to mount. Residential construction comes to a grinding halt, with sharp rising total listings, dwellings for sale. Mortgage defaults begin to rise, as does the unemployment rate. And the mindset here is we're doomed. Property investors and recent homeowners feel like their world is crashing around them, and the level of fear of job losses and bankruptcies are considerable. And stage 5, he says, is a clean out. The property market eventually finds its floor price. With limited credit available despite bank bailouts or nationalisation, cashed-up buyers and private funds purchase distressed debt and dwellings at discounted rates. And properties are relatively cheap, but most people have difficulty accessing credit. And prices slowly begin to rebound. And the mindset now is, what do we do? Confusion abounds. And all the public was ever told by the establishment is that property only goes up, but the opposite occurred. As a result, many people turned to alternative wealth creation opportunities outside of the property market. Now, this so-called property bloodbath, he writes, is the inevitable outcome of the irrational exuberance driven by debt finance speculation that has seduced and mesmerized a large proportion of society into becoming over-leveraged. And the report points out how some of the banking shenanigans contributed to the bubble on the way up, and how curtailing them is contributing to the downturn now. Australia's house price growth model revolves around Ponzi-like leverage, with lenders systematically accepting the unrealized capital gains of a property as a substitute for a cash deposit to borrow to purchase another property during the boom period. This has resulted in many property purchases using 100% financing, forming a clearly excessive cohort of speculative buyers that otherwise wouldn't exist if lenders had adhered to responsible lending obligations. The declines in Sydney and Melbourne house prices since the peak in 2017 have diminished some of the unrealised capital gains, leaving speculative property buyers, particularly those who recently purchased at or close to negative equity. Without enough unrealised equity, this cohort of buyers will increasingly be shunted into the sidelines with no ability to purchase. The report by FL Economics then lists a slew of headwinds that will put further pressure on this still overinflated market as it heads lower and on the banks. Here are some of them, quoted from the report. Mortgage application rejections. The rate of rejections has skyrocketed by over 1,000%. Half of all new applications are rejected. 90% of those with pre-approval have had their loan sizes reduced, and refinance rejections have increased from 5% in 2017 to 40% in 2018. This is an outcome of the Royal Commission prompting lenders to abide by responsible lending obligations. With credit becoming tighter, restrictions are likely to keep on rising, causing some potential borrowers to wait on the sidelines. Interest-only reset shock. Approximately 120 billion of interest-only loans will reset to principal and interest over 2018, 19, 20 and 21, tapering off thereafter. Banks and regulators have already softened their stance on these borrowers, allowing some greater time to sell the property or extending the interest-only period for a while. But nevertheless, with debt payments rising anywhere between 20 and 50% upon conversion to principal and interest, many recent borrowers will be placed under considerable financial stress. Class action lawsuits. A supportive legal and financial environment for class action lawsuits has hit fertile ground, with the Royal Commission revealing widespread criminality and misconduct in the financial services industry. Driven by the profit motive, experienced litigators will fund numerous class actions on behalf of those harmed by the industry. In doing so, this may bring more criminality to light, reduce industry profitability, and force banks to adhere to the rule of law in a way that the captured regulators have not done so in decades. And we note that today Westpac is subject of a class action relating to poor mortgage lending standards. Next, foreign buyer exodus. China is the largest source of foreign investment into the housing market in terms of both the number of purchases and value of the investment. With China's central government ramping up capital controls to stem the outflow of capital and imposing jail time for those facilitating such flights, purchases of new and established dwellings have fallen considerably. Furthermore, there is mounting evidence the Chinese government is now forcing the sale of properties owned by nationals and repatriating foreign currency back to the homeland. This will particularly affect the off-the-plan apartment complex market. Rent slowdown. The annual growth in nominal rents is very low and negative in real terms. Sydney is particularly affected given that nominal dwelling rent growth is falling by around 3% annually and more so in real terms. With current construction rates delivering a considerable flow of new houses and units, nominal rents will continue to decline into the near future, harming the balance sheets of investors, especially those who are heavily negatively geared. Investors with rental properties that have negative cash flows, whose only hoped for benefits are capital gains and full tax deductibility of losses. Construction faults. With the Opal Tower and aluminium cladding scandals, the media and public have become more aware of the veritable plague of construction defects within the mass of apartment complexes and townhouses. Option to purchase contract buyers may choose to relinquish their deposit rather than purchasing a potentially defective dwelling and bearing the future costs of rectification. In some cases, rectification costs are greater than the purchase costs of the complex, leading to an expected negative value. Expense benchmark crackdown. The Royal Commission indicated that lenders could not solely rely on expense benchmarks such as the HPI, HEM and internally driven estimates to determine if ongoing household expenses render a loan unaffordable. Lenders must perform due diligence and obtain verified expense information from borrowers. This will significantly reduce the maximum loan size that can be originated, given such benchmarks have woefully underestimated actual expenses of borrowers, often by half or more. Comprehensive credit reporting, CCR, is currently 50% active and will be 100% active by July 2019, as lenders are obliged to provide relevant borrowing data to credit agencies. It also allows lenders to see any and all existing debts of borrowers which may have been previously unavailable or hidden. Bank funding and capital raisings. International money markets have provided remarkably affordable funding, enabling lenders to originate large and risky loans, but they now face cost pressures. If house prices continue to fall, there are risks of credit downgrades stemming from lower profitability and rising non-performing loans. This will likely cause wholesale funding costs to rise, particularly short-term rollovers and future hybrids or other capital offerings despite backdoor coverage by the RBA. APRA is also requiring the major banks to raise tens of billions of dollars more to boost Tier 2 capital buffers, diluting earnings for 2019. For 2019, LF Economics anticipates nominal house prices not adjusted for inflation to drop between 15% and 20% in Sydney and Melbourne, on top of the drops suffered in 2018 and 17. While forecasts of around 20% falls in the calendar year alone may be dramatic, some commentators will point to the significant run-up in prices over the years, Lindsay writes. This fails to note that housing is not a simple unleveraged EFT. It is a highly leveraged play, amplified by fraudulent lending practices and Ponzi finance, with implications for financial stability on the downside. Now, I was asked to comment on the report on 7 Sunrise today. Here is the relevant segment.
He says houses will be very affordable again, but the risk of recession will be very high. For more, we're joined by Martin North from Digital Finance Analytics. Martin, good morning to you. These sort of reports often annoy me because they are just blatant scaremongering. We know property prices are deflating. We've seen it coming from the construction boom of about 3 years ago. How low do you think values will go?
Yeah, well, there are a number of negative indicators, and remember that interest rates are ultra low at the moment. Yeah. And the fact of the matter is, it's either interest rates or unemployment that normally triggers home price falls, but that isn't the case this time. What's changed is credit availability. So if credit availability continues to be as tight as it is, and I suspect it will be thanks to the regulators and their intervention in the marketplace, we're going to see continued falls in house prices. My own view is it could be 20 to 30% peak to trough in Sydney and Melbourne. But if you get an international crisis over the top, then effectively the feedback loop gets even worse. And it's worth saying that, Lindsay isn't the only person calling a fall. Even some of the mainstream people are now saying there is going to be a fall. The question is, how far
That's right.
How fast and how long. And that's the unknown factor at the moment, right? But it really is about credit, because credit is the trigger for home price growth when credit is more available. And the reverse is also true. Credit will be tighter for longer.
Sort of to translate that for normal people, the Banking Royal Commission has forced the regulators to crack down on the banks, so the banks are a bit scared to lend money to people, so we're in an old-fashioned credit squeeze. But the other side of it is unemployment's really low, jobs growth is still there, Reserve Bank seems to have been good at sort of managing the economy over the last couple of years, so there are other factors to bring in.
Yes, I agree. Unemployment is very low at the moment, although, of course, wages growth is not really following that, and that's a problem. Costs of living are continuing to rise. So a lot of people with big mortgages are finding it quite difficult to service those mortgages now. And also probably investors who, of course, always thought that property prices would go up and then get capital gains. And they're saying, hang on a moment, why would I buy if prices are going to continue to slide? And even first-time buyers are now saying, well, if I wait till next year, I'm going to be able to buy cheaper. So there's a bit of a change in the demand-supply. So this is a complex picture, right? And there are lots of elements, both locally and internationally, that could change the outcome. But frankly, I can give you lots of reasons why home prices will slide. I can give you very few why they would rise.
OK, all right. But a deep recession, banks collapsing and being nationalised, I think sort of that's at the horrendous end of the scale. Mate, thank you for joining us. Here's Sam.
And as you see, Koshi defended the RBA, but I think he was surprised by my comments. And as more analysts call the falls ahead, it will be harder for the mainstream media to maintain the RBA's rose-tinted view. We are, I fear, going to see more trouble ahead. And we discussed this recently when we updated our scenarios in this week's live stream. As the RBA admitted this week, slowing household consumption can certainly dent the growth forecast. And we are currently only at the end of Lindsay's stage 2. So there is more, so much more to come. As always, if you like what you've seen here today, please share the post and like the post and add or comment a question. I read them all. And if you've subscribed, thank you so much. I appreciate your support. But if you haven't subscribed yet, please do so to receive alerts on future posts. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.